Want to start investing but not sure where to begin? In this video, we'll break down 5 beginner-friendly dividend stocks that can help you build long-term wealth and passive income. Learn why companies like PepsiCo, Microsoft, Johnson & Johnson, JP Chase, and Williams companies are considered strong foundational investments for new investors. What if you could own shares in companies that not only grow over time, but also pay you cash just for holding them? That is exactly why dividend investing is one of the smartest places for beginners to start. And no, you do not need thousands of dollars, a finance degree, or years of experience to begin building a portfolio that creates passive income for you. In today's video, we're covering 5 of the best dividend stocks for beginners in 2026. These are companies with strong brands, reliable cash flow, long histories of paying their shareholders, and business models that have proven that they can survive economic uncertainty. We'll break down what each company does, why it's beginner-friendly, what makes its dividend attractive, and what risks investors should still understand. By the end of this video, you'll have a solid foundation for building a long-term dividend portfolio. Let's get into it. One of the biggest challenges that new investors face is emotional investing. When markets fall, beginners often panic because they only focus on stock prices. But dividend investing changes the mindset. Instead of only asking, is my stock price up today? Dividend investors also ask, how much income is this investment generating for me? That shift in perspective is really powerful. Dividend-paying companies are often mature, stable businesses with predictable cash flow, and these companies tend to experience less volatility. They tend to survive recessions better, they reward their shareholders consistently, and they grow wealth steadily over time. And when dividends are reinvested, you can take even more advantage of compounding. That means that your dividends buy more shares, and those shares pay more dividends. And over years or decades, that snowball effect can become quite substantial. For beginners, dividend investing creates a balance between growth, stability, and passive income. Before choosing dividend stocks, there are a few important metrics that every beginner should understand. The first is dividend yield. This tells you how much income a stock is paying relative to its share price. For example, a 3% yield means that you earn about $3 annually for every $100 invested. Right? So if you purchase $100 of shares and that company pays a 3% dividend, that means you receive $3 annually. That's your dividend yield. The next key term is called the payout ratio, and this measures how much of a company's earnings are being paid out as dividends. Lower payout ratios usually mean that the dividend is safer and has room to grow. It means that the company has extra cash to make sure it continues to pay its dividends. Then there's dividend growth, looking at the growth of the dividend payments over the past few years. A company that consistently raises its dividend year after year shows good financial strength and shareholder commitment. We also need to be aware of earnings growth. That is the growth of the company earnings. Dividends can grow substantially if the business itself continues growing. Strong earnings growth supports future dividend increases. And lastly, balance sheet strength. Companies with manageable debt and strong cash flow are more likely to maintain their dividend payments during recessions or market downturns. Now let's look at 5 beginner-friendly dividend stocks that check many of these boxes. The first is PepsiCo, ticker PEP. PepsiCo is far more than just Pepsi soda. The company owns some of the world's most recognizable food and beverage brands, including Pepsi, obviously, and then Gatorade, Lay's, Doritos, Mountain Dew, Quaker Oats, and Tropicana. And this diversification matters. So even if soda sales slow down, things like snack foods and sports drinks continue to generate enormous revenue. PepsiCo operates in more than 200 countries around the world and benefits from products that consumers buy repeatedly regardless of the economy. That makes the company highly resistant. And if we look at PepsiCo's dividend strength, PepsiCo has increased its dividend for more than 50 consecutive years, placing it among the elite group known as dividend kings. Its dividend yield typically sits around the 3% range, offering a balance between income and long-term stability. The company also generates extremely strong free cash flow, which supports future dividend growth. And why is PepsiCo great for beginners? Well, for beginners, PepsiCo is an ideal starting point because the business model is pretty easy to understand. People buy food and drinks in every economic environment, and that consistency creates dependable earnings. PepsiCo also gives new investors exposure to consumer staples, a sector known for stability during market downturns. And because the company combines dividends with moderate long-term growth, it helps beginners experience both income and portfolio appreciation. The biggest risks include changing consumer preferences towards healthier products and rising ingredient costs. But PepsiCo's brand strength and global scale have historically helped the company adapt over time. For our second stock, we'll be looking at the Williams Companies, ticker WMB. The Williams Companies operates one of the largest natural gas pipelines in Northern America. Its infrastructure transports natural gas across the United States, serving utilities, power plants, and industrial customers. Unlike oil products, Williams doesn't rely heavily on fluctuating commodity prices. Instead, the company earns revenue through long-term contracts and transportation fees. That fee-based model creates a more predictable cash flow. Williams is known for a relatively high dividend yield compared to many other large companies. Its dividend is supported by steady demand for natural gas infrastructure, especially as electricity demand continues rising from data centers, artificial intelligence, and industrial growth. The company has also improved its balance sheet significantly over the past decade. For beginners looking to generate stronger passive income early, Williams can be attractive because of its higher yield. It introduces investors to the energy infrastructure sector without the extreme volatility often associated with oil exploration companies. The business model is easier to understand than many complex energy investments. Williams essentially gets paid to move energy through pipelines. That creates revenue similar to a toll road system. For income-focused beginners, this stock can help accelerate the compounding effect of reinvesting your dividends. Risks to consider. Energy infrastructure companies can still be affected by regulatory changes, interest rates, and economic slowdowns. And because higher yield stocks can sometimes experience more price volatility, beginners should balance income investments with other sectors. Our third dividend-paying company that we're looking at today is Microsoft, ticker MSFT. Microsoft is one of the most dominant technology companies in the world. Its business spans Windows operating systems, Microsoft Office, Azure cloud computing, artificial intelligence, gaming through Xbox, and enterprise software. And what makes Microsoft particularly powerful is that many businesses rely on its products every single day, and that creates recurring revenue and massive competitive advantages. Although Microsoft's dividend yield is lower than some traditional income stocks, the company has consistently increased its dividend for over 2 decades. More importantly, Microsoft combines dividend growth with exceptional earnings growth. The company generates enormous cash flow and holds one of the largest balance sheets in the corporate world. Microsoft is a fantastic beginner stock because it gives investors exposure to both growth and dividends. Many younger investors focus only on high-growth technology stocks that pay zero income. Microsoft offers a middle ground. You still get to participate in long-term trends like artificial intelligence, cloud computing, software subscriptions, and digital transformation, but you also receive growing dividend payments over time. And for beginners, this teaches an important lesson. that you do not have to choose between growth and income. The company's financial strength also makes it one of the safer large cap technology investments available. As always, there are risks to consider. Technology companies can still face valuation risk. When investors become overly optimistic about AI or tech growth, stock prices can become super expensive. But Microsoft's diversified revenue streams can help long-term business risk. The fourth dividend-paying company we're looking at today is Johnson & Johnson, ticker JNJ. Johnson & Johnson is one of the most established healthcare companies in the world. The company operates across pharmaceuticals, medical devices, and consumer health products. Healthcare is considered a defensive sector because people still need medical treatment regardless of economic conditions, and that makes companies like Johnson & Johnson especially valuable during uncertain markets. Johnson & Johnson has increased its dividend for more than 60 consecutive years. That incredible consistency has earned it Dividend King status. The company's cash flow, global reach, and diversified healthcare operations support its ability to continue rewarding shareholders. Why it's great for beginners? Well, for beginners, Johnson & Johnson provides stability. Healthcare demand tends to remain steady over time. And Johnson & Johnson's diversified business model reduces the dependence on any single product. The company also teaches an important investing principle. Great businesses don't need to be exciting to build wealth. Sometimes consistency, resilience, and reliability are exactly what help investors stay calm during volatile markets. Johnson & Johnson can act as an anchor in a beginner portfolio. It also offers something that new investors underestimate: peace of mind. Knowing your investment is backed by decades of dividend growth can make it easier to stay invested during market downturns. Healthcare companies can face risks from patent expirations, lawsuits, and government regulation. However, Johnson & Johnson's scale and diversification have historically helped it navigate those challenges. And despite occasional short-term challenges, the company's long-term reputation for stability remains one of the strongest in the entire market. The fifth dividend-paying stock we're looking at today is JP Chase, ticker JPM. JP Chase is the largest bank in the United States and one of the most influential financial institutions in the world. The company operates across consumer banking, credit cards, investment banking, wealth management, and commercial lending. And because of its scale and diversification, JP generates revenue from multiple areas of the economy. JP has built a reputation for strong capital management and consistent dividend payments. With a dividend yield typically between 2 and 3%, the bank has steadily increased its dividend over time while maintaining one of the strongest balance sheets in the banking sector. Its profitability and disciplined risk management have helped it outperform many competitors during periods of financial stress. The company also generates billions of annual profit, giving it flexibility to continue rewarding its shareholders while investing in future growth. For beginners, JP provides exposure to the financial sector through one of the industry's strongest companies. Banking is deeply connected to the economy, interest rates, consumer spending, and business activity. Owning a high-quality bank helps investors diversify beyond technology and consumer products. JP is also beginner-friendly because of its leadership position. When uncertainty hits the financial sector, investors often gravitate towards the biggest and most stable institutions. That relative stability can make the learning process less stressful for new investors. Another reason JP stands out is its ability to adapt. The company continues investing heavily in digital banking, artificial intelligence, and financial technology, helping it remain competitive in a rapidly evolving industry. For beginners, JPM offers a combination of dividend income, financial sector exposure, and long-term growth potential. And the risks to consider for JPM? Well, banks are sensitive to recessions, interest rate changes, and credit losses. Financial stocks can also experience volatility during economic uncertainty. However, JP Morgan's scale, strong management team, and disciplined lending practices have historically helped it navigate difficult periods better than many competitors. One reason these 5 stocks stand out for beginners is diversification. Together they cover multiple sectors: consumer staples through PepsiCo, energy infrastructure through Williams Companies, technology through Microsoft, healthcare through Johnson & Johnson, and financials through JP Morgan Chase. And that diversification matters because different sectors perform differently depending on economic conditions. If one area struggles, others may remain strong, and this helps reduce overall portfolio risk. And just as importantly, each of these companies has a recognizable brand, a strong cash flow, a history of rewarding shareholders, and long-term relevance in the economy. These are exactly the kinds of businesses that beginner investors should focus on when building a long-term foundation. And here is something that every beginner investor needs to hear and remember: you do not need to chase the highest yield. A company paying a 10% yield may look exciting, but if the business is weak, the dividend can disappear very quickly. The goal is not only high income, the goal is sustainable income. And that is why quality matters. Strong balance sheets, reliable earnings, consistent dividend growth, and businesses can survive for decades. The companies in this video are not get-rich-quick investments. They build wealth slowly and consistently investments. And historically, that approach has created far more successful long-term investors. Dividend investing rewards patience, and the earlier you start, the more powerful compounding becomes. The 5 stocks we covered today, PepsiCo, Williams Companies, Microsoft, Johnson & Johnson, and JP Morgan Chase, each bring something different to a beginner portfolio. Some offer high income, some offer stronger growth, and some provide defensive stability. But together they represent the kind of high-quality businesses that can help investors learn discipline, build confidence, and grow their long-term wealth. And if you found this video helpful, be sure to like and subscribe and share it with someone who's just started their investment journey. In the comments below, let us know which of these dividend stocks would you choose first. Thanks for watching. We'll see you in the next video.